What's up, everybody? It's your boy, Brandon, back with another edition of the Macro Insights Podcast. But first, before we get started, a little disclaimer. I am not a financial advisor, and the guest is not giving financial advice. So everything you hear on this podcast is strictly opinion and should not be taken as financial advice. We disclose if we have any holdings discussed in this podcast, and you should not be following us as financial advisors. You should discuss this with professionals before you get involved or invested. And as always, it's not financial advice. So please take this strictly as our opinions and for entertainment purposes only. Now let's get into the show. What is up, everybody? I'm back with another edition of the Macro Insights Podcast, where I'm here with my good friend Deerpoint Macro. We're going to talk about everything from the Fed, Canada, all this other kind of stuff. If you've heard him on Twitter Spaces, you know about the cross-currency basis swap, so I'm sure we'll dive into that as well. But before we get started, big shout out to my sponsors, Pleb Lab. So if you're in Austin, you need to check out Pleb Lab. They're right off of 6th Street. They're the best hacking space in the business. They got a lot of events going on. They got the Fresh Bites Market on July 1st. So if you're a vendor or something like that too, still looking, they still have open spaces, I believe. So be sure to check them out. And if you're not in Austin and you're thinking of going there at some point in time, or you want to get access to their Slack channel, talk with some of the best minds in the business, you can get their Nomad Pass. Their Nomad Pass is $100 a month. You get access to their Slack channel, all their private events via YouTube, and you can go to them when you're in town, and you get access to the facility whenever you're in town. So be sure to check them out there and get yourself a Nomad Pass. And if you're going to BitBlock Boom, use promo code Green Candle, 10% off of that ticket, and Pleb Lab's going to be having a lot of events. Also, big shout out to Idaho Armored Vaults, Bob and team at goldsilvervault.com, the best place where you can get precious metals. They have extensive amounts of liquidity. They're certified, and they have the lowest margins that you could possibly get when it comes to buying and selling the precious metals market in the United States. So if you're looking to get in there, why not check out Bob and team at goldsilvervault.com, shoot them a message, and tell them Green Candle sent you. All right, enough of me blabbing on. I got to get my good friend Deerpoint Macro up on stage. Deer, how you doing, man? This feels weird talking to a deer, but how are you?
I'm doing well, man. How are you doing?
I'm doing great. So for those who don't know you, or maybe didn't even hear the first episode, I mean, you were like the first guest I think I had. And at that time, it was the Sunday Scaries Stock Talk Pod, so a mouthful. But first, a second, I guess, appearance on the show. So, how you doing? And reintroduce yourself for those who don't know you.
Yeah, so I'm Deerpoint Macro. I am a deer that has the ability to be able to speak. But in all honesty, no, I'm just a big macro enthusiast. I work for a bank up in Canada. I had the pleasure of meeting Brandon last week. Had some fun and interesting times. So it's good to be back. I feel honored. I've been obviously we've been kind of together for a long period of time now. I guess it's almost been 2 years at this point.
Yeah, I think we've been interacting on 2 years, like right when Twitter Spaces started. I think we were kind of interacting. You were like one of the first people that came into the Tuesday night spaces, and yeah, man, I mean, you just blown up on the scene. So, but we'll kind of leave, I guess. Well, maybe we'll leave for our story a little bit towards the end or something like that. But I want to jump right into it, right? So, I mean, you alluded to it. I was in Toronto not too long ago, and we hung out a little bit, but it was kind of an interesting time while I was up there. Canada decided to re-raise interest rates because they previously paused in their last, I don't know what their equivalent is of the Fed. And the Fed in the United States decided to pause, but it's seemingly like they're going to raise on the next meeting. So overall, give us, I guess, your lowdown on the overall macro state of I guess both Canada and the United States, kind of what you're feeling of where they're at.
Yeah, so I guess we'll start with Canada first. Canada's an interesting case in comparison to the United States. because Canada never went through a deleveraging cycle. So if you go back to kind of, let's really start at the beginning of the GFC. You know, Canada was obviously at the household level extremely indebted. And once you kind of had the great financial crisis, Canada just kind of stagnated in terms of household debt to GDP. And since then has been on this rolling trend upwards, where I believe now they're at like 102 or 103% household debt to GDP, whereas the United States went through a deleveraging cycle throughout the great financial crisis, which really cleaned up household balance sheets. The reason that this is significant is Canada's different than the United States in a lot of ways. One being, if you look at a mortgage, for example, in the United States, you can get a 30-year fixed. And like, for people who don't know, I'm actually for like an American. I'm just working in Canada. And so when I talk with Americans about this, they're always like, wait, what do you mean? Because when you look at Canada, yes, you have a 25 or 30-year amortization, but you only have a 5-year fixed or a 5-year variable. You can get 10-year fixeds, but again, that's extremely uncommon. So when you're looking at these variable rate mortgages, essentially somebody on a 5-year fixed who got a mortgage, let's say in 2017 at, 3%, is now going to have to refinance at 7%, or not really refinance, but they'll have to roll the mortgage at 7%. And so you're talking about a huge increase in debt servicing, right? I've heard stories of people whose mortgage payments have already gone up $2,000 to $3,000, right? And who really budgets for that? So when we're kind of looking at Canada really has to thread the needle carefully here. And on my most recent pages, I've been kind of focusing on this. I put some charts out yesterday looking at total debt obligations within Canadian households as a percentage of disposable income. And it's almost gone parabolic. And now you're starting to see obviously rise in solvencies on a year-over-year basis, albeit, off a very low base because, the pandemic, there was a lot of kind of support programs in. But that's really where we are, at least looking at the Canadian context, where if they don't want this whole thing to implode on themselves, they're going to really have to be extremely careful in setting forward guidance for interest rate policy, just because of so much of that debt essentially being variable. Just already the increase in debt servicing cost has been absolutely massive. That's a little bit different than the United States, where households are not as indebted. I think household debt to GDP, maybe 70 some odd percent, 75. I don't have the number in front of me, somewhere in there, but significantly lower than Canada. And, that kind of gives the Fed the ability to be able to continue to kind of raise rates because you haven't started to see pressure on the US household like you have on the Canadian household.
Yeah, and I mean that is basically, I think that the biggest cog when it comes to the differences between Canada and the United States is just that variable rate mortgage. But we're also seeing, like, in the United States, which I think is interesting, a lot of I guess affordability is what I'll call it, movements in housing. I know, like, housing is just a small cog in it, but we're seeing things where some places are trying to offer 0% down outside of just a normal VA loan. And there's talks of changing the 30-year fixed to a 40-year fixed because there's worries that the younger generation can't afford a home with all of this massive amounts of inflation that's kind of gone in these hard assets. But when it comes down to it, I think it's like, I don't have the exact numbers, so I'm not 100% sure on this, but I know it's like over half of the entire mortgages. I want to say it's even closer to like 60 or 70% of the mortgages are under 3% right now in the United States. So, down here, we basically have a lot of people that are going to, are in their forever home, or going to essentially die in this home until, or live in it long enough to get enough appreciation where they can, buy a little bit nicer of a home or something like that. But they're essentially locked in at a very, very cheap rate. Whereas, I think like you pointed out, the biggest difference is, just that variable rate where, after 5-10 years, whenever that arm gives up, the way that the Fed is, or I guess Canada's version of the Fed is raising interest rates, that's just going to change dramatically on the monthly payment scale. So I guess let's dive into the differences then in the United States, right? I mean, we had Powell just pause, but it seems like it was kind of a pause, and everything that's come out since that is essentially preparing us for another rate hike, it seems, in July. So, where do you think the United States kind of is? And, I guess, where do you think it's going?
Yeah, I mean, on this aspect, obviously, I've really kind of missed the ball. I mean, for me, I thought that the Fed should have started cutting much earlier. Obviously, that actually hasn't happened yet, as everybody knows. I mean, my whole reason for believing that was essentially, liquidity events, which I would argue that we did get in the, issues within the U.S. banking sector. But broadly speaking, most of that has kind of been kind of pasted over, right? So I do think that the Fed could continue to move higher here. How much higher is really the question, um, because when I'm looking at the data, I don't see the need for them to continue to hike rates. And the reason that I say that is if you look at where we are, the PPI, which is the producer price index, last year around this time, it was 11.3%, I believe. As of today, on a year over year basis, it's 1.1%. That index is now 60% services. And we're seeing a lot of deflation through freight and shipping costs. And so once you start to kind of look at these metrics and you start to back things out, you realize that I do think that the job has been accomplished, but because the Fed is looking at lagging data and they're not looking at everything in its entirety, they're kind of glancing over a lot of things. So just like if we look at, core or headline, right? 30% of headline, 40% of core is OER, right? The owner's equivalent rent. We know that this is a flawed metric because it's a survey. And obviously when you're calling homeowners, asking them how much will you rent your house out, they're always going to give you top dollar, right? That doesn't necessarily mean that that's the market, the going market rate. And if we actually look at real-time market rates, we know that they're actually deflating. So people who are now moving into apartments or condos or new rental units are actually paying less than they were last year. That hasn't really been pulled through into the data. So, when the Fed is starting to look at these things, we have to realize that a lot of this is inputted guesswork, right? At least for the CPI and the core. And, even Greenspan used to say, CPI is a useless metric. The reason that I like the PPI is because where does pricing come from, right? In theory, it comes from the producer, right? So if the producer has higher input costs, or has to pay higher wages or has to pay higher transportation costs, they're going to pass that on to the consumer, right? They're not going to eat most of that themselves, willing that the consumer is willing to pay that. And a great example of this is David Rosenberg, who's used to be the economist at Merrill, but he's now working for his own firm here in Toronto. He actually said that if you look at the amount of price increases because of fiscal and monetary tailwind throughout the pandemic, the companies were able to pass 4 years of price increases into a single year. So they had this massive amount of pricing power that they could pass on to the consumer because the consumer was getting money from the government. and that kind of allowed them to continue normal consumption patterns. So, I mean, I think that once we start to look at things like that, obviously that's all gone, right? That tailwind is out of the way. So what do we really like? Where do we go from here? And so I think that that's why when you look at things like Walmart, when you look at things like Costco's, et cetera, there's elasticity of demand there, right? So they when things become too expensive relative to the ability of consumers to be able to pay for that, they can lower price to spur demand, right? But that lower price is obviously disinflationary, deflationary. So now that they're saving all of this money, if consumption does start to kind of slow, they have the ability to come in and actually lower prices. That's much different than things, like gas stations, right? You never see sales 50% off at your local gas station because, there's inelasticity there. But because everybody needs gas, right? So they'll pay for it. No, really, in theory, no matter how expensive it is, right? You need it to get to work. But that's much different from things like clothes, where there's more kind of pricing power there for corporations. So I do think that we're going to start to see some of that, those sales start to pass through if consumption does start to dwindle. Thus far in the United States, we haven't seen that, though. So, I mean, I do think that now we're really kind of looking at disinflation. I believe that that's where we're headed. So, I think the Fed's job's done. But again, they just focus so much on that PCE number. I just think it's kind of blinded them to other factors of things going on within the economy.
Yeah, I mean, it's interesting that you say that because, Powell has come out, I think, in the last couple of days and said, inflation is stickier than they thought it would be. Although at the beginning of all this, they were kind of saying inflation's transitory, like it's not going to last very long or whatever. But it seems like they're trying to get down to that 2% CPI target. And it's, obviously it's arbitrary or whatnot, but it seems like, they're going to just continue to raise interest rates, but they're looking at backwards looking data. And in my opinion, it seems like they're not even really looking at some of the things that you're talking about, right? They're not really looking at the consumer. They're more looking at, just overarching job numbers, which is, just essentially survey-based data and everything like that. So, I guess one, like, why do you think that the Fed is not, or do you think, one, that they're looking at this kind of data that you're pointing out, and two, like, if they are, or if they're not, like, why or why not? And if they are, like, why are they not seeing like some of the things that you're pointing out, do you think? Take a leap into the mind of Jerome Powell for me, dear.
Yeah, I just think it's because they got burned so bad on the transitory narrative. But I do believe that people over kind of transitory was overblown, because if you open a dictionary, not to be, like kind of semantics here, but transitory doesn't have like a time limit. It just means not permanent. So, I mean, essentially anything that is not permanent is theoretically, in the sense of the word transitory, transitory. But people kind of gave the word transitory a time frame. So I think that was a lot of the issue was, their old posturing being taken as, transitory will be, 6 months to a year, right? And I think that that's how a lot of people interpreted it. That doesn't necessarily mean, though, that that's what it is. And so, I think that when you're kind of looking at the Fed, that's how they're positioned now, is we don't want to be burned again. We don't want to lose credibility. So we're just going to stick to our guns. But again, on the opposite end, that is going to have real effects that do start to make their way through the economy, where you could have the potential of slowing economic growth. Thus far, we haven't seen that, but that possibility still is there. So I just think, in the mind of Jerome Powell, he's just so scared of backing off and inflation coming back. But again, I would say that they've most likely accomplished that task.
Yeah, I mean, I don't know. It just seems like because Powell has the Volcker mindset, right? Higher for longer, and all that kind of the mantras that he's been putting out there. It just seems like he's not going to stop until that CPI number is at 2%. But in the meantime, it seems like there's going to be a lot of you alluded to it. You work in a banking industry, and obviously there's been plenty of problems in the banking industry in the United States. Three, I think, of the last either 4 or 5 largest bank failures happened within this past like 6 months period when the Fed was raising interest rates. So, what kind of strain do you think that this will, I guess, put on the rest of the banking industry? Do you think, maybe we'll see some more big players potentially fall, or do you think, as we're kind of going through this, that there's, I guess, more room for, I guess they're more prepared in a sense.
Yeah, I mean, I think somewhat they are more prepared. So, I mean, I guess when we are looking at this, we need to first look at, SVB, which was, I'm sure most people remember, kind of the first bank to really go under. And, when we start to look at this, Silicon Valley Bank invested deposits in long-term bonds and MBSs. And they tried to do this to increase the yield and bank earnings at a time when rates were extremely low, right? And the value of those bonds had a high level of sensitivity to interest rate increases. And so, this led to capital markets freezing up, and corporations issued very few bonds. And we also saw this exposure that that seems to be related to their holding of fixed interest rate assets that are held available for sale or held to maturity. And what we essentially saw is that they had these two measurements, right? They had a measurement of HTM at cost does not make interest rate, or like essentially they had this measurement where they estimate the unrecognized pre-tax fair value loss of these assets. And I believe it was in the range of like 14 billion, and about 89% of their reported equity due to the rise in interest rates, right? So once we start to kind of look through what happened, this was almost all related to bad mismatch, right? So they had something called economic value of equity, which they say is the value of assets less the market value of liabilities. But within their modeling, the market value of liabilities included the assumption that there were zero to low interest rates, and that deposits themselves would remain relatively sticky. And so, those are obviously payable on demand. And so they were assuming that I believe it wouldn't go above, 75 basis points. So when we kind of look at what happened with SVB, this was all a function of interest rate risk, because, as yields move higher, the value of the bond moves lower. And so essentially they were taking on these massive losses from that, because all of these long-term and MBSs were very sensitive to changes in interest rates. And that's just kind of how they were modeling things out. So, I do think that obviously there could be some more pain, but I think the worst of the worst is behind us, right? Because anybody who had significant risk, your SVBs, your FRCs, your PacWests, not that all of those failed, but the ones that really got, some of which failed, and the ones that got absolutely obliterated, I think is kind of, that aspect is in the rearview mirror now, right? The market kind of got sniffed out which ones would be able to survive and which ones wouldn't.
Yeah, and I think, to that point as well is that there's not necessarily going to be like, I mean, at least it would be crazy, but I don't think there's going to be any more like 75 or even 50 basis point hikes. I think, if the Fed kind of continues to do this like pause, raise kind of cycle throughout the rest of the year, it's probably going to only be like maximum 25 basis point hikes from here on out. And so because of that, I think like, just the rapid pace, not only of what you outlined of Silicon Valley Bank and a lot of these banks that were, essentially just mismanaged. I think the rapid movement of the rate hikes was also part of the reason why, they got crushed and got crushed pretty quickly. It seemed like, overnight, obviously, but it was, that and obviously the spread of information with people on like Twitter and some other social media apps that are saying like, hey, this bank's in trouble. Let's get our money out. So caused a bank run and everything else too. So but you've alluded to it, right? I mean, like you admitted that you thought like that they should have turned and switched up theoretically, and like kind of started the pivot at some point in time, now, but it seems seemingly like they're not going to start until 2024. But what is that doing to, the dollar markets? I know you love your cross currency basis swaps and that kind of thing, but looking at the strength of the dollar, right? I mean, I was just in Canada. We already talked about it a little bit, but I mean, generally speaking, the Canadian whatever loony toony whatever you want to whatever it is usually a little bit more than a dollar. But when I went up there, it was like $1 is equal like, or I guess one loony is equal to like 75 cents theoretically. So I mean, you can really tell the strength of the dollar when you cross the border. So I guess how is that strength of the dollar being affected with all these interest rate hikes just globally to other fiat currencies, I guess around the globe?
Yeah, so obviously, I mean, what we're seeing is now people fleeing from domestic assets and other, currencies to the United States. And so if we actually are looking at what's happening, people are trying to get a hold of dollars. Now, to keep the cross currency basis swap very simple for maybe listeners who don't know, it's just think of it as a gauge of dollar demand. And so the more negative it gets, the more of a premium you have to pay to essentially be able to get dollars. So you're paying the person lending you. In very simplistic terms, it's a little bit more complicated than that, but the so we do have a bit of the basis is still negative, so that's still in favor of a shortage of dollars. It has eased slightly, but nevertheless it's still negative. So we are seeing demand for the dollar continue. I think that that's going to absolutely continue into kind of the next couple of months or so, just as a function of the fact that thus far the U.S. is kind of the cleanest dirty shirt. If you look at Europe, Europe, people are saying is in a technical recession. You don't really want to put your money in Canada. Obviously, China's slowing. So when you start to look at other large kind of global players and in like from a macroeconomic standpoint, a lot of these guys are slowing. And sure, you could make the argument the US is slowing, but not to the same capacity. So like, this is going to hurt nations like, like Germany more, like China more, nations that even though they are large exporters, whatever they do have to import from the US is obviously going to rise in cost. But, a lot of these nations slowing as well is a bit interesting because a lot of these nations are surplus producing nations. And so if they're slowing, and we are going to start to see, let's say, less exports coming out of these countries. Some of their PMIs are starting to turn over, not in contraction yet. Germany is now starting to roll over. It's still in expansion territory, but not by much. It's like 2 basis points, I believe, above above contraction. So we're not talking about a whole lot that's needed to kind of pull that into contractionary territory. And so, I do think that the rest of the world is starting to slow. If we look at the Tens curve for the Bund, which is um, the German bond, it's negative 79 basis points, which is the most inverted since kind of the 1990s. So we're now seeing economic growth expectations roll over and become negative in Europe. We're seeing, the city economic surprise index become negative, showing, anticipation of slowing in Europe. But again, that's going to push a lot of money, I believe, into the U.S. Just because that's going to, one, be the only place that you can really get a positive real yield. I believe in the U.S. Real yields, and when I'm talking about real yields, I mean like an inflation break even against a similar treasury. So like a 5-year break even versus a 5-year treasury. That's how you calculate the real yield, not using CPI. I believe in the U.S. it's about 170 odd basis points. So even from that aspect, we do have the highest real yields in the world, and I do just think that that's going to continue to be attractive for capital to continue to flow to us. And I mean, I guess we can touch on BRICS next if you have any questions on that, because I was going to go there but didn't want to throw too many things out at once.
Yeah, no, let's dive into it, right? Because, right, we got the status of BRICS. They've either announced or kind of like alluded to them creating their own sort of, I guess, like maybe it's a central bank digital currency, CBDC, some sort of digital crypto. There's even thrown out like, certain countries have allowed trade in cryptocurrencies. And it seems like they're trying to throw out that they can trade in essentially almost any other currency outside the dollar. So, I guess, what is your thought on not only BRICS, but I guess like other countries now are starting to move away from trading in the dollar. So, although it seems like the dollar is strengthening against other crypto or other fiat currencies, like what is, I guess, does it worry you that other, countries are starting to not trade in the dollar, or is it one of those cases where they, trade in, I don't know, the yuan, for example, and then to just do an immediate exchange into the dollar, and it's just the trade was kind of done in a different currency, so to speak?
Yeah, so for one, it doesn't worry me. And so I'll kind of go over some data here. Um, if we look at the overall compensation or composition, sorry, of globally disclosed FX reserves on a quarter-over-quarter basis, the U.S. share of globally disclosed reserves was up about 47 basis points. And that accounts for about 58% of all disclosed FX reserves. Now, if we were to look at the renminbi, that accounts for 2.69. Now, obviously, if we look at the growth rate of the renminbi in terms of its overall increase in its makeup of globally disclosed FX reserves, it has been remarkable. The rate of change has been, very rapid. It's been more rapid than the pound. It's been more rapid than the franc. It's been more rapid than the yen. But when people are looking at like rates of change, they have to remember it's coming off a very low base, right? So if you're talking like a 10% change in, 1% relative to a 10% change in, um, 1,000%, or it's going to be much larger at a lower base than it is from a much larger kind of composition, and that's what we're seeing with the renminbi, right? The renminbi is about I think around 300 billion, but in a global market, the nominal figure of globally held FX reserves is 12 trillion. And so, almost 60% of that is denominated in the US dollar. And so this kind of leads us to, people talk about settlement. China will settle trade in yuan. But there's a difference between settlement and invoicing, right? So I guess first we should kind of touch on what is invoicing. What it is it's kind of it postulates a dominant currency paradigm where export prices are set in a so-called vehicle currency. And so what that means is export prices are set in US dollars. What they're settled in doesn't really matter. It's more how they're invoiced. And so really invoicing is only done in two currencies. It's done in the euro and it's done in the US dollar. And so, if we kind of look at the gap between export invoicing in dollars versus export destined for the United States, it shows the role that the US has in global exports. So what we really see is that global trade is more than just the petrodollar or commodities. And once you actually deduce exports out from both importing or from both invoicing and export shares, the dollar share of invoicing is 23%, exceeds by a large gap the share of exports, which are destined for the US, which is only 10%. And so one can already kind of see the role that the US dollar has in global trade from that aspect. And the euro in and of itself in invoicing is more of a regional player. It's big in area, obviously Europe, it's big in Africa, it's big in some areas in the Middle East. But when we start to look at these things, one, BRICS doesn't really have the ability to start invoicing because, invoicing in and of itself, you get something called exchange rate pass through. And as X currency invoicing plays a bigger role in the pass through of exchange rate fluctuations to prices, thus, higher X invoicing shares massively increase pass through. And so, you can estimate that 100 basis point increase in X currency invoicing share leads to 30 to 60 basis points increase in pass through. And so the reason that this is significant is if you have a currency that's extremely volatile, like you've seen in South Africa, like you've seen in Turkey, even recently, like you've seen with the yuan, it actually leads to instability in global trade. And it would actually slow exports, which would then, overall slow global trade. And so when I'm looking at like invoicing, I don't care too much about settlement because, like I said, trade has been settled in things other than dollars for a long period of time. It's more invoicing that's significant. And I'll end it here is if you actually look at nations that are invoicing in dollars, what is very interesting, or who are settling in yuan, like Saudi Arabia. What's interesting is once they get those yuan, what do? They immediately go to the PBOC and they take back dollars, right? So they're like, here, you can have your yuan back. We just want dollars. And so this is the thing. And this is the last point because this is also significant. China has capital controls. So even onshore, if you want to convert your yuan into dollars, there's a constraint on how much and how often you can do that. So this has actually led to offshore markets like cross-currency basis swaps, like FX swaps. And so what's then happening is people are going offshore, and we're seeing this. So like you're seeing outflows, like capital outflows from China, but you're not seeing a decrease in FX reserves. And so that means everybody is taking those and they're swapping them from dollars in kind of the shadow banking sector because they can't do it onshore because there's just too much restrictions on the amount of currency that they're able to convert. So all of that's happening offshore. So, this is the thing. It's all of these nations, I posted on Twitter a couple of weeks back as well. If you took the aggregate of the BRICS nations, all like BRICS in aggregate is net long dollars. So they have so this is how they're essentially positioned. It's not something that you'd see if they were, again, moving away from a dollar-based system. All of these nations want dollars, and all of these nations are trying to get dollars through the shadow banking sector. So again, I think BRICS is broadly overblown.
Yeah, that's a fair point, right? I mean, because at the end of the day, too, all those dollars, are all those currencies that they're using, whether they're converting it back to dollars or anything like that. That's how they're valuing, the price of everything, right? They're not pricing anything that they're trading in, yuan. They're kind of pricing it into dollars, or at least that's what it seems like to me. Correct me if I'm wrong, but it seems like they're pricing things in dollars and then seeing the spread on whatever the currency that they're using, and then that's how they're pricing whatever they're trading. Is that correct, or does that sound right?
Yeah, exactly.
Yeah. So I mean, at the end of the day, everything's still priced in dollars. That's like kind of I guess although there's, I guess, more countries kind of trading in things outside of the dollar, it still seems like the dollar still reigns king. But I know you said you're not worried about BRICS or any of these other things, but it seems like this. Maybe it's because I'm paying attention a little bit more now, but it seems like this is kind of happening a little bit more frequently than it has in past, at least since the dollar's become like the global reserve currency. Would you kind of, I guess, agree with that point, or have we gone through something like this prior, where countries have kind of, I guess, reverted from the dollar in trade and kind of tried to move away from it?
Yeah, I mean that's where it's hard, because I know if you go back far enough, like you'll find um, periods in like the 1980s where it's like headline Kuwait says that they will stop trading in dollars, right? I think that was one headline from the 1980s. So like, I mean, this has been around. What, now that you actually gave me an idea for a chart, is to go back and kind of pull data of how many times this has been said, and just see how much, if whether or not it's more frequent today than it was, you know, 50 years ago, 60 years ago, or if it's just the ability of access of information, right? Where, if you get on Twitter and you see, the end of the dollar, the, total kind of addressable market of people who are going to get that information is much larger than it was 60 years ago, where it was more concentrated, right? Even if you're flipping through a paper, right? Like, I remember my grandfather used to read papers, and he'd like go to like the sports section, right? Like, you're not going to read through the entire paper, right? You're going to go see, how the Braves did, or how the Tigers did, or something like that. You're not going to read through every article, and a lot of times, there's those tiny little articles in the very back of the paper that nobody, really ever saw, that weren't headline news, right? Like, people usually read headline news and sports, and that was about it. Whereas now you just have like this information overload, so it just might be more in your face than it was, 30, 40 years ago. But I'm not sure if it's really a new argument. This seems that it's been something that's kind of been going on for a long period of time.
Yeah, I guess that it probably is the case, right? I mean, more people are paying attention. There's greater spread of information, right? I mean, that's kind of like, I feel like it makes the things that are going on a little bit more dramatic. But it also, I think, in a sense, like can make things a little bit worse, right? Because, you know, it would normally take, I guess, like some time or maybe some communication between a couple countries to see, hey, like, I don't know, Saudi Arabia, for example, is not going to trade in dollars from now on, or they're not going to, export in dollars. But, normally I feel like countries wouldn't figure that out until, they're trying to trade with Saudi Arabia or something like that, maybe take some sort of public announcement where everybody would hear it first. But now it's like, if anybody says anything, it's immediately on Twitter or some other news source or something like that. So, I mean, I feel like even the spread of information from country to country is even quicker. So, I think that is kind of a good point, that it plays a role. But I'd be curious to see that chart. So maybe I'll put you to work for me here, dear, and let you show me, how, how many countries have kind of moved away from the dollar, and if that's kind of I guess, a common trend in years past. But before I let you go here, I kind of want to get your last, I guess, outlook for the rest of the year, because we've kind of talked about some like rearward facing data. Like, we've talked about the moves the Fed has made and even the moves that the Canadian Fed, whatever it's called, has made, and kind of the effects of that, and why you think that they maybe should have pivoted or switched it up, a little bit earlier. But I want you to call your shot here, on at least the United States side. Like, do you think that we're going to get to, I guess, a pretty severe recession, or even just, a recession in itself? Do you think we're in one? Do you think we're going to get to a depression? Like, how do you think this all ends up playing out?
Sorry, couldn't get to the unmute button. Yeah, so do I think that the US is in a recession? No. Not yet. I do think that the US is somewhat slowing, but it's nothing that I would say that, as of now, one should be concerned about. I, you know, I think that there's a lot of kind of good that comes out of that. You know, but if we really want to avoid slow economic growth going forward, I think that we need to focus more on fiscal policy than monetary policy. We need to focus on technological advancement. We need to focus on, finding ways to increase productivity, increase output. The good thing is, if we do get layoffs, I do believe that there is good to be had in that, in the sense that high nominal wages, in and of themselves, are not inflationary. It's wages adjusted for productivity, which in economics is called unit labor costs. So if nominal wages grow at 5% and productivity grows at 5%, you don't have an issue. You have an issue if nominal wages grow at 5% and productivity is negative 5%, right? So, that's where we are today, where productivity is deeply negative. And so we're getting less output compared to where we were a year ago, but nominal wages are higher. So that means we're adding more workers, to, fixed factors of production, like, plants, machinery, equipment. Even in the service sector, if you go to a pizza restaurant, you can only have so many people in the back utilizing an oven. You can only have so many bartenders pouring beer before, like, if you have think of a bar, right? If you have just a normal bar, maybe if you have one bartender, you can serve 10 clients an hour, right? And then if you add a second one, you can serve 20 clients an hour. And a third, you can serve 25 clients an hour, and a fourth. And so you get kind of like a parabola, right? So in the beginning, you get increasing increasing returns from adding more bartenders. But then at a point, you get less. It's still increasing, but at a decreasing rate. And then finally, you're getting, it's decreasing at an increasing rate. And I think that that's where we are. We're adding more employees to things that are already fixed factors of production, just because we kind of have this issue of labor hoarding, and therefore output's actually declining because nobody's more productive. You're just adding more people, right? Like if 10 people are crowded around one fax machine, you're not going to get a whole lot of things faxed, right? So, I believe that is where you could start to see that aspect, like unit labor costs or actual wage inflation, start to come down, as once we start to lay people off. I also believe that will increase output. But what we really need to start to focus on to kind of avoid all this, again, is fiscal policy, where we're getting investment into the private sector, and we're building out, things that do lead to increases in productivity, because long-term increases in technology and productivity lead to long-term increases in the standard of living. And so, I know that that's a bit of a drawn-out thing, but I do think that, yes, we could have some slowing in the U.S. economy. But thus far, I don't really see signs of a recession. I think that we could have a soft landing, kind of coming into the end of this year, beginning of next year. So, you're talking anywhere between 3 to 4 quarters. So, you know, I think that that's where we could kind of see it.
Yeah, and I wouldn't be surprised too if when we start to see a little bit more pain. You know, it's like the Fed is going to revert course a little bit later than they should. I mean, in your opinion, they've already, you know, haven't done that. So, I mean, I wouldn't be surprised too if it's, you know, it seeming like they started raising too late. I wouldn't be surprised if they start pulling back too late. I mean, it's human error in a sense, and they're looking at all backward looking data, and it seems like it's not really the most efficient way to look at the data as well. So, but dear, my friend, outside of you know, maybe Friday nights at the Toy Box or or some other place, maybe the Loose Moose or something like that, where can people find you, and what all do you got going on?
Yeah, so it's mostly on Twitter, and then I do have my Substack, which is also Deer Point Macro. So Substack and Twitter are really the two places to find me. Obviously, outside the Loose Moose, you know, with the brewskis flowing, sipping on a nice IPA, especially now. It's good IPA season, by the way. It's just like a nice time to start cracking open IPAs. But yeah, those two places, or the streets of Toronto, nothing east of Bay, like you dragged me to. Brendan literally just dragged me to the end of the earth when he was up here, and I was like, I have never gone this far east in my entire life. So thank you for showing me the other side of Toronto, even though you're not even a Torontonian.
Hey, but I mean, you got to give me some credit, dear. You can't just rip me apart on here in front of my audience. I mean, like I live in Tampa, Florida. I got us into some random club that I never heard of before I got to Toronto for free when they were charging $50 a head. I mean, come on, you got to give me some credit, man.
I do have to say he did, but we also have to mention we had like a 45-minute walk, and I was wearing cowboy boots.
That is true. It was a long walk from where we were at, but I had no idea. So I mean,
yeah. I mean, it was fun. I mean, we saw interesting things. We saw like a party in an alley that was a mosh pit.
Oh yeah,
you know? Yeah. So
yeah, we saw that. We saw a couple of homeless people. I mean, we saw some stuff. I mean, I got the full tour of Toronto while I was up there, man.
Yeah, you did really get the tour. So I mean, I do have to say, you know, at least we got the full experience. We had delicious pizza, you know,
Yeah.
and pasta. So you know, there was good aspects of it. But yeah. So that's where most people can kind of find me. Um, yeah. I mean, you should definitely come up again. I mean, I'll be going down to South Carolina in September. Maybe I'll try to make a stop by Tampa. We can.
Yeah, man, you're always welcome down here. Yeah, I mean, I'll probably make it up. Maybe I'll come back if they have the Canadian Bitcoin conference again in Toronto or something. I don't know. Maybe I'll make another trip up, or maybe to New York or something. You can come down, and it's a little easier that way. But yeah, if you guys aren't following Deer Point on Twitter, follow him, Deer Point Macro. He's all over Spaces too. He's always sharing his knowledge. So great follow, and then check out his Substack, of course, man. I mean, this guy, he's pumping out all this stuff all the time. Great charts and great, you know, breakdown and analysis. Obviously, you guys just heard it all. So, Deer Point, thanks so much, my friend. I'll catch you at the Loose Moose, man.
Yeah, thanks, friend. I'll see you there.